comments contained in this podcast do not constitute legal advice. The opinions herein are the opinions of the speakers and not the official opinion of the Hodgson Russ Law Firm. Hey there, tax fans. Welcome to State Tax Talks with me, your host, Joe Tantillo. I'm a tax attorney at the Hodgson Russ Law Firm looking to explore the nuances of state and local tax law. Here on the show, our goal is to keep tax informative, simple, and fun. So if you're ready to talk tax, turn up the volume and dive into this episode of State Tax Talks. Ladies and gentlemen, welcome back to another episode of State Tax Talks. I am your host, Joe Tantillo, and I am joined once again by my colleagues Mark Klein and Andrew Wright, and we are talking top residency traps, common residency mistakes that we see all the time in moves out of New York to Florida to Texas to New Hampshire. You name it, we've seen it. And we're discussing today these common issues that come up that tend to be bad pieces of advice or mistakes in the tax return that happen to various taxpayers. And we want to enlighten you as to why these issues are usually not good things for your domicile case. So we're going to resume our discussion right now. Up next is statutory residency trumps domicile.
Yeah, I mean, this kind of gets to the topic Mark was alluding to a minute ago, which is we'll often talk to people as, year-end approaches, right? I'm going to make a move to Florida in, November of 2024, right? I'm gearing up for it now. I'm planning for it. I'm going to head down in the fall. When the weather turns, I'm going to plant the flag in Florida, become a Floridian in late 24, and that's when I want to claim my change of domicile. And it probably works just fine, right? From a domicile standpoint, you can do all that. You can identify a date this fall. You can take action consistent with that. But when I'm talking to someone in September who wants to move in November, I'm going to ask them, how many days have you spent in New York so far this year, right? Because if I'm moving to Florida in November, I'm going to keep my place in New York or a place in New York, and I've exceeded 183 days in New York based on the time I've already spent. I'm going to end up being a statutory resident in the year I change my domicile, right? Because statutory residency trumps domicile. And that,
I've had people go to Florida and, they move the kids into school. They clearly are Floridians by September. Mm-hmm. They keep the place up north because Florida's not as much fun in the summer. But by September, they are absolutely Floridians. No one can doubt their domicile. So they wait a month or two, and then in November, they sell their Google stock or their Bitcoin. And I usually make sure that Drew calls them to tell them the bad news.
That's when it becomes a difficult conversation, right? If I moved in November and I get tripped up by the statutory test, but I didn't have a particularly large income event in November or December, I may not get punished that much for my mistake. But if I do this move very intentionally, I become a Floridian on November 1st, and then for whatever reason, I sell all my Google stock in December. I have this really large income event, and I think I'm a Floridian, I'm good. Then we have to be the bearers of bad news to say statutory residency trumps domicile. You're going to get taxed as a full year resident despite your very clear change of domicile.
It comes up to a lot in the context of people saying, well, after I'm audited, I can go back to spending as much time as I want in New York, right? Not right. If you still have a place there and you're more than 183 days, you're going to trip that statutory residency test and be filing a New York resident return. Do too many of those in a row, and all of a sudden New York might be saying, I wonder if this guy changed his domicile back to New York. And sure, the burden switches, but you don't want to put yourself in that position after you've done all that work and spent all those, hot Florida summer months, put the time in. It's an important thing to remember that those tests work side by side, and you can run afoul of the statutory residency test if you're not careful and you're not counting. So keep those records, count your days. Which brings us to the living quarters box, which is related very directly to the statutory residency test in that it's pretty much part two of that test. We're just talking about days. Now we're talking about, whether you maintain a permanent place of abode in New York, which relates not only to statutory residency, but also is related to domicile for purposes of this conversation. But there's a box, I believe it's section H of form IT-203 that says, do you maintain a place of residence in New York? Yes or no?
It says abode.
I think it says a place of abode. Yeah, that's right. It doesn't say permanent.
Living quarters. Did you maintain living quarters?
Did you maintain living quarters? Yes or no? Number one, You must check yes or no. You should not leave the box blank. Although leaving the box blank is preferable to
lying.
point number 2, lying. or even misunderstanding. That box is basically, I always read it as permanent place of abode and use the same analysis in my head. So again, go listen to our OBIS podcast to find out what a permanent place of abode is. But if you have a permanent place of abode in New York, you must check that box yes. If you have a permanent place of abode in New York and you check that box no, it can potentially land you in a world of trouble. I know you've got a story that I'm sure you're going to want to tell about.
I've got one involving an accounting firm. The accountant, their response to checking the no box is that the software defaults to no. And yeah, maybe it does, but the wages line also defaults to 0. The idea is you're supposed to put the right number in. So the box got checked no. Yet what the accountant did is, usually when you prepare a tax return, you do the federal tax return first because New York starts with federal AGI, just a gross income. So they do the federal return. They get it all worked out, and they push a couple of buttons, and it ports all the information over to the New York return, in this case, a New York non-resident return, all of your income, all of your deductions, yada, yada. Well, unfortunately for the accountant's return for this taxpayer indicated that the taxpayer did not have an abode in New York, and at the same time took a deduction for mortgage interest and real estate taxes on the place the client didn't have. That landed the accountant in a world of hurt because New York said it is inherently inconsistent with what you filed, and they hit them with preparer penalties. It's very unusual, and at least I've seen preparer penalties, but this accountant got hit. And of course, the client also got hit with penalties on their residency return, and the auditor's response to the client was, you misstated. And of course, what does every client say? I don't look at my return. I just, the accountant says sign here. So you know what I do? I sign here. But you're, of course, ultimately responsible for the return that you sign under penalty of perjury. And the real tough part here is if you get hit with penalties and you really told your accountant you had the place, you can go after your accountant, which doesn't please accountants either.
Yeah. I mean, I can't tell you the number of times this question gets answered incorrectly. I mean, it's
by big account.
Yeah,
it's probably close to 50% of the returns I see that are getting audited. This question is answered incorrectly. And it gets to Mark's point about consistency, right? We'll talk to the clients and they'll say, I have a 1,200-page tax return. I file a federal tax return. I file in 10 different states. This is one very specific question on one page of the New York tax return. Do you really expect me to have gone through every single page of this tax return to verify every single thing that's on it? And practically, that makes a great deal of sense, right? Our clients hire accountants for this reason. They're not going to pore through every detail of the tax return. But if it's answered incorrectly, an auditor is going to point it out, and then it's going to form, an opinion in their mind about whether they can rely on the other things that are on the tax return.
Yeah, that's a great point. It puts, an aspect of whether this taxpayer is truthful in the auditor's mind right away. And as Mark alluded to earlier, they're already incredibly skeptical of taxpayers. So doing anything to undermine your own credibility, whether it is intentional or unintentional, is not wise, especially when going through the process of planning to change your residency. Think about, taking all of the steps that we tell people to take years in advance, and your accountant has checked that box no, and you've done all this great stuff. And now the auditor is hung up on it and really kind of trying to drag you through the mud because they ran a public property record search and they see that, the house that was on your return the year before shows it's still being owned by you in the subsequent year.
Yeah, I'll give you another horror story. I had, again, probably 15 years ago, I had a client who checked the no box, who insisted he had a place, but the accountant screwed up. And the New York City district attorney subpoenaed the accountant's email records. And sure enough, there was an email from my client saying, please don't check the box that says I have a place in New York City. I don't want to get in trouble with New York. He put that in an email. And I mentioned that the New York District Attorney's Office did the subpoena because they were involved and the case went criminal.
Oh, jeez.
Didn't you, Mark, also one time have a client who on December 31st every year on his or her calendar had an appointment that said something about making up a number of days. Reminder to lie about the number of days I spent in New York this calendar year.
Create fictitious list now.
I mean, look, the reason this is a trap, right, is because credibility is hugely important in the area of domicile. Domicile is a test that deals with your intentions. And when you tell an auditor, or we tell an auditor on behalf of the taxpayer what this taxpayer intended, what their intentions were, we want explanation to have credibility. And when the auditors can point to things that potentially impeach the taxpayer's credibility, like, well, geez, you lied to us on this tax return, it can sort of lead an auditor to have questions about the credibility of what we're saying.
Sure. The last thing you want to do is be in a position where the auditor looks at you and says, well, were you lying then or are you lying now? You pick one.
Yep. And that is not a good situation to be in.
Nope.
Well, let's talk about consistency. Consistency with an exclamation point, as it is written on the list in front of me. Consistency is key in any of these moves. You have to, as Mark alluded to earlier, moving is actually a real part of changing your domicile, and remaining consistent with respect to how you are living your lifestyle in the new place, especially with respect to time, can be critically important.
Yeah, and I think the other aspect with consistency is that very often we will see people who move to another state and then they ultimately decide to sell their place up north because they really do enjoy their new state. And of course, for a married couple, there's a $500,000 federal and state tax exemption if you sell your principal residence, or at least a place that's been your principal residence 2 out of the last 5 years. Well, if you've been a Floridian for 4 or 5 years, it's very hard to say my New York place was my principal residence for purposes of the $500,000 exemption, but for purposes of the income tax, I'm a Floridian. Same thing we see with star exemptions and any other New York real estate.
Rent-controlled apartments, co-op abatement.
And you look very bad to an auditor when you seem like a pig, because every time there's something that goes in your direction, you claim to be a Floridian, but when it can save you money in New York, consider yourself a New Yorker. That really gets under their skin, and justifiably so.
Yeah, even with smaller stuff like resident memberships at country clubs that you didn't change because you didn't want to lose the ability to play golf on, Saturdays and Sundays. Like, an auditor doesn't care about that.
Yeah, these are the kinds of things when I see consistency that come to my mind first, right? It's like you're telling the auditor that for income tax purposes, you live in Florida, right? You're not a New Yorker anymore. But in all these other ways, when it's to your benefit, you're saying you're a resident of New York, right? I want the benefits at the club. I think, Mark, you had an example one time where someone wanted to pay less for their hunting license or something like that, right? I want these other benefits. I want the property tax benefits. I want to get the condo abatement. I don't want to pay sales tax on my parking space in Manhattan, right? There are all these kind of benefits you can get as a resident that are not income tax benefits. And if you're taking those benefits and then saying, for income tax purposes, I'm not a resident, that's just inherently inconsistent, right? And it gets to Mark's point a minute ago. Are you lying to us on the income tax return, or are you lying to these other people that you're saying, to get certain benefits, you're a resident of New York?
Yeah, and a lot of the time what happens when people are taking those benefits or those exemptions, not so much in the country club world, but certainly with property tax exemptions that you should not have been entitled to, if you want to win your audit, you're going to have to pay it back. So it's coming out of your pocket at some point. Better to just do it up front and not create inconsistencies in your change of domicile case than to, drag that out, have the auditor think you're a liar, and then also be cutting a check to the New York State property tax board or whoever it is that you have to send the check to pay back the money that you were not entitled to.
Yeah, keep in mind, when you get audited, the first questionnaire you get is fairly straightforward. There's only, I think, 8 or 9 questions on
10.
it. 10 questions. But one of them is, are you taking any of the following tax exemptions? The star exemption, the parking exemption, et cetera. That they want.
Do you have a rent-controlled or rent-stabilized apartment?
So they're looking for that right off the top.
And it's all part of the cost-benefit analysis that, I encourage everyone to do when making a decision as to whether they are going to change their domicile, outside of New York. What is the amount of money you're going to be saving on your taxes? And, what's the real benefit of getting those various exemptions or the cheaper hunting license, et cetera, or playing golf on Saturdays and Sundays? Look at how much money you're going to save as to opposed to these benefits that you may lose, and you make the determination, because for a lot of our clients, the tax savings are in the hundreds of thousands of dollars and or more. And you know what, you can go to Florida, and if you're an ultra high net worth person, maybe you can join Seminole or some great incredible course down there and play on Saturdays and Sundays in the sunshine.
And you're not going to buy an auditor's love when you explain to the auditor that your country club dues in Florida are twice what the auditor makes all year.
Yeah.
It really doesn't resonate with them.
No. And if anything, it just makes them angry and introspective. Oh, why did I take this job? All right. In a similar vein to consistency, let's talk about moving back quickly after a claimed change. This is a huge red flag to auditors and their supervisors and section heads. And it's not to say that you can't have a successful change of domicile case in which you move and then move back in a relatively short time span. In fact, the Blatt case is a perfect example that our firm litigated where we won on such an issue. However, that is the exception, not the rule.
And it went all the way to court.
It went all the way to court.
Yeah.
Yeah.
Yeah. Well, the reason it's a trap or a red flag is because it stands out to New York, right? If I move out this year, right, I file a part year resident return in 24. In 25, I'm a non-resident. And then in 26, I move back, I'm a part year resident again, right? They generally do these audits in 2 or 3 year cycles. And if I've got move out and move in such short proximity, it's going to look strange to them on the surface, right?
How have you landed, right?
You have to intend to have abandoned New York as your home and landed in the new state to remain permanently or indefinitely, and yet you're back within 2 years. And often, right, the Blatt case being a good example, there's a really good explanation for why that happened.
Yes.
But if we're thinking about like what are the kind of audit red flags or traps, like this is going to stand out.
I've had people ask me on planning calls, or not even ask me. They've told me, well, I'm looking to do this move, and then we go through everything, and at the end of the call, and they're like, and I'll probably only be in Florida, 3 or 4 years. And what do I need to do when I come back? You need to not come back.
Yeah.
Yeah. And one thing about auditors, say what you will, but they do have phenomenal 20/20 hindsight. If you're already back by the time you're being audited, you're going to get a hard time.
Oh, yeah.
Yeah, I had a conference call this morning with some auditors on a case where folks moved to Florida at the end of 18. By about the middle part of 21, they were back. And the audit's just for 2019 and 20, so years where they were claiming to be Floridians for both years. But of course, the nature of these audits, right? This audit's been going on a long time. Other years have passed. They've started asking, what does the following year look like? All of the facts have come out that these people returned, that they didn't keep a place in Florida after 21. And to Mark's point, the auditors are looking at it and going, well, what are we even talking about, right? You're saying they moved to Florida and now they don't have a Florida place and they're back in New York. Hindsight's 20/20, right?
Yep.
We're not going to agree they moved with the intention to remain permanently in Florida.
Yeah, and if you are one of those folks who has a unique situation where you did have a really good reason for the move, and then you also had a really good reason for the move back, don't overlook that that's going to create some complexities for you, and go and talk to someone. Call Mark Klein, call Andrew Wright, or talk to your accountant at a bare minimum, because when you do get audited, you're going to have some hurdles to overcome.
Yeah, and if you do have those discussions on the front end, right? I mean, it doesn't change the nature of, well, you're probably going to get audited. The audit might not be super straightforward, but then you at least have the opportunity to think in real time about how can I document and demonstrate the reasons for these changes, right? Things are happening in real life. I'm making decisions about my life. I'm not necessarily thinking at the time, well, what kind of proof am I going to be able to put in front of an auditor 3 years from now to explain why I'm doing this, right? And if you talk to someone in real time, like us, we can tell you, right? Here are the ways you need to document this so that if an auditor asks about it 3 or 4 years from now, you can prove to them why you're doing what you're doing.
I mean, there's a great old adage that if you ever want to make God laugh, you should just make plans. And that really is true, right? You plan to do whatever, but life gets in the way.
Yes.
And so there are circumstances that will cause you to come back to New York or do whatever. And as Drew said, just make sure you can document the fact that something changed, something out of your control. It wasn't that I went to Florida and I didn't like having dinner at 3 p.m. anymore. It was, my employer called me back, which is what happened in Blatt. Or my wife was diagnosed with the disease that only the Memorial Sloan Kettering in New York City takes care of. And I'm not going to, mess around with my wife's health. Yeah, those are good reasons. But you need a reason other than I didn't like it, because that makes it look like you never really stuck that landing.
Yeah, you were just testing the waters, right? We went to Florida, we tried it out, we didn't like it, we came back.
Yeah, that's not a move.
That's not
a move by any standard.
Right.
Well, speaking of wives, husbands and wives usually share a domicile, and yet we get calls on a regular basis saying, I'm moving, my wife's not, or I'm moving, my husband's not. Can it work? Sure. Is there a presumption in the law that suggests that it is abnormal and you have to overcome it? Absolutely.
Makes sense, though, right? Most married couples live together. They share a life together. They share a home together. And it's unusual, and it is possible. But for one spouse to be a New Yorker and for the other spouse to be, let's say, a Texan, it's just out of the ordinary, right?
Yes.
And you really have an additional burden or hurdle to jump over because the expectation is that you share a life with this person.
Yeah, I mean, especially when there are minor kids involved too. Like if if the kids live with your wife in New York and you're trying to claim, that you are a Texan, that's going to be really, really hard, even if you've got 250 plus days in Texas. Again, nothing's impossible in this context. It's all subjective and every case is looked at independently. But the splitting up of families is not something that auditors look at.
I must tell you one story, though, because one of our audit managers, Mike Van Wagenen, was a supervisor for the tax department at the time. And I had Mike and one of his auditors join us, and we had a situation where husband was a professor at a university. The wife wanted to have a good financial and educational opportunity for her children, so she stayed in New York. And, the auditor kept saying, well, don't you see your kids? Don't you do that? And the client said, not really. I really do. I live in my head. I live in New Jersey here. And the auditor looked at the client and said, well, you must not be a very good parent. and Mr. Van Wagenen called her out on that. But still, that's what the auditors think.
Yeah. Well, and the practical implication, right, of spouses having a different domicile is you're going to spend a heck of a lot of time apart, right? Sure, we have separate domiciles, and don't you come back to see your family? Well, no, I spend my time where I live, right? And when I talk to people who want to do this, and it's more common than you think. I mean, I think it creates lots of difficulty, but that's the first thing I tell them is, look, if, husband wants to move to Florida, he's retired, he wants to play golf 5 days a week, and wife still has her life in New York and doesn't want to move. It's entirely possible, right? But the practicalities of it mean that, husband's going to need to be in Florida a heck of a lot more. Wife's not going to be there. You guys are going to be apart, right? And if husband goes down there and, spends 200 days and then is back in New York 160 days and wife's here all the time, it's just a recipe for disaster in an audit, right? Because if domicile is a home is where the heart is test, and I'm constantly coming back to New York to see the person who's the most important person in the world to me, the auditor is going to say, your heart's here, right? You live here.
There's a handful of listeners out there who just heard this and went, honey, I'm moving to Florida and you can't come. I'm sorry. Yeah, we have to spend a lot of time apart.
My lawyer, can you put that in writing? I must.
All right. Let's talk about tax forms that have your old address on it or are inconsistent with, new residents. It's not just tax forms too. I mean, tax forms is kind of the main thing. If your W-2 or your 1099 or your K-1 is using your New York address when you are a Floridian, that's going to be a problem. But it kind of goes hand in hand with a lot of the other formalities of, what's the address on your credit card statement, on your bank statement, et cetera. All of those things should kind of comport with where you are saying you actually live.
I don't think it hurts in a residency audit because, again, it's a piece of paper. Mm-hmm. It's certainly not determinative in that regard. But if you're looking to be audited, it is the perfect way to get audited. Because the tax department's going to get a W-2 with a New York address, and you're going to say, but I'm not a New Yorker, and then it becomes a pretty fast audit. Yeah,
or even better, a non-resident New York tax return with only a New York mailing address on the return, right? You're saying you live somewhere else, but the only address we see on the tax return is a New York address, right? I mean, it gets to the consistency question too, right? Which is we want all this stuff to be consistent. I tend to agree with Mark that this shouldn't be a big deal.
Yeah.
But auditors do make a big deal of it, right? So just as an example, we just had a hearing on a contested residency case at the end of May. And one of the things that the auditor was very hung up on, right? The question is, did these people change their domicile into New York? And the auditor's looking at these tax returns where the taxpayers filed as statutory residents of New York. Listed Connecticut as the home address, but there's all these other boxes on the tax return. What's your county of residence? What's your school district number? There are these boxes that say, how many months did you live in New York, right? In New York City when you file an IT-201. And the auditor's picking up all these things on the tax return, even though the tax return says Connecticut's the home address, that could theoretically suggest that home is New York, and saying, this is the reason I know these people moved in, because they listed Manhattan is their county of residence, right? They must have intended to change their domicile into New York. So it comes up all the time.
I've even seen it in the context of people using a care of address on their tax return just because, they send all their stuff to their accountant's office, for example, and maybe that's in New York. You have to be extra cautious and give thought to all this stuff. And again, as both of you have said, it doesn't mean it's fatal, but it goes back to that underlying credibility that we want to build with an auditor before they even select your return for audit. So you just gotta have a reason or a purpose. If you're using a care of address, it never hurts to attach a rider and say, just to be clear, the address on this return is not the personal home of the taxpayer. It's merely an address where mail is received.
I think one of the cases you and I worked on when you were a brand new attorney, Joe, was that kind of thing, right? Mm-hmm. Someone was maybe out of the country and they needed to file a New York non-resident tax return, but they didn't have an address where they could receive easy mail overseas. And so I think they used the care of address for the accountant in New York.
That's right.
And I don't even think that led to an audit notice. I think New York just sent them a bill, right?
I think that's right, yeah.
New York address on your non-resident tax return. You're a resident. Here's a bill.
Yeah, I had a similar thing recently, and it wasn't even an out-of-country person. They just had an address where they felt much more comfortable that the mail went to, and it just so happened that address was in New York.
Well, I mean, in New York City in particular, usually if you are in Florida for a few months, your New York City doorman will put your mail together for you.
Yes.
If you've got a home in Florida, you don't have a doorman necessarily, so it's easier. I get that, but as Drew said, it's just it causes problems.
Yeah. How about letting the client chat with the auditors? Good idea or bad idea?
Generally bad. I mean, the issue here is you kind of can't unring a bell. And so we know all the kind of nuances and technicalities and verbiage that is important in this residency area, and taxpayers generally don't, right? And even in something that feels relatively innocent, right? I just got this audit notice. I'm going to call the auditor and confirm I got it and tell them I'm working on it. The auditor can start asking questions and like, geez, who knows what they ask? Who knows what the taxpayer is going to say? And I've had this circumstance happen all the time where it's like 2 years after the audit began, the taxpayer had one conversation with the auditor. We've handled the audit for 2 years. And at the end, when they're making a determination on residency, they cite back to something that the taxpayer said in that very early call.
Well, my favorite one is the taxpayer says, "Are you serious, auditor? I'm in Florida 8 months a year. I don't come back home until, usually until as late as October."
Back where?
Yeah, exactly.
Yep. I've unfortunately seen situations like that. The small mistakes that can be made.
A lot of clients, because, to your point earlier, New York is generally auditing people that have a lot of income, right? That's where the money is in these audits. And so they're generally very successful people that are being audited. They often have a lot of confidence in their ability to tell their story and communicate. And, they think, geez, if only I could talk to this auditor, I'm sure I could, get the auditor to agree. And it often backfires.
And we've had clients who are accountants. We've had clients who are lawyers who think that they know how to handle it because I'm a lawyer. Certainly I can resolve this issue myself. I'm an accountant. I must understand, the how to work a state tax auditor. You don't necessarily know. You just don't. If you don't deal in this space all the time, as Drew said, there is a ton of nuance. There's a ton of specific verbiage that needs to be used to make sure that you don't put yourself into a hole.
And keep in mind, as Drew pointed out, auditors make notes of everything that you say.
Yes.
And it goes in their contemporaneous diary. DO 220, is it the form?
The audit log, yeah.
The audit log. And, 2 years from now, you're going to find out, surprise, your client undercut the position that you've been espousing for the last 2 years.
I've been doing this for 15 years, only slightly longer than you, Mark. I can definitely count on less than one hand the number of times that I have purposefully put a taxpayer in front of an auditor to have a discussion. It's exceedingly rare, right? There has to be a very sort of unique circumstance that presents itself where I decide this makes sense, right? The auditor must hear from the taxpayer directly about this issue.
Yeah. Personally, I've yet to do it. Keep them away. Let's talk about issues with credits for taxes paid elsewhere and where that can create trouble for the taxpayer.
Yeah, I think it's because accountants often will use the W-2 and just assume that the W-2 is correct. And W-2 is simply a statement, but it's not reality, right? You have to comport the numbers on a W-2 to reality. And the other situation I see a lot is you get an executive, let's say in New York, who maybe they work in New Jersey. And, they're CEO of some big company, so they go to New Jersey every day, and they pay a big chunk of money to New Jersey, because that's where they're working, and they ask New York for a credit for the amount that they paid. And here's a cancel check that I paid $1 million to New Jersey. And New York says, well, that's great. And you physically went to the New Jersey office every day? Well, I'm the CEO. I visited other offices. I did the trade show in Europe. I went here and there. Well, New York says, look, we'll give you a credit for any time you were in New Jersey working for your business in New Jersey. But why should we give you a credit for taxes you paid to New Jersey when you were in California or when you were in Europe at the trade show? And then you say, but I paid New Jersey $1 million. Here's a canceled check. And New York will say, that's nice, but just because you chose to overpay New Jersey doesn't mean New York is going to give you a credit. In fact, we're not. We're going to take it away. Go file a amended return with New Jersey, and we'll hit you with interest. And currently, what is the interest rate, Drew?
I think it's 10%.
10%.
Right now. Yeah.
And talk to your accountant about how this happened.
The sort of strange part about this topic is, unlike a lot of the other traps, this comes up mostly for New York residents, right? So not only does New York audit people who change their residence, they very regularly audit people who are residents of New York. And why do they do it? They do it for the reason Mark just mentioned. Well, I live here and would otherwise pay tax on everything to New York, but I pay tax on 100% of my very big W-2 income to some other state like New Jersey. And New York comes in and says, was that right? Did you actually owe New Jersey tax on 100% of the wage? If not, we're going to disallow some of that credit and we get to keep some of the tax. And it can have huge impacts, right? Because all sorts of things happen, right? Other state has statute of limitations running, right? And in Mark's example, I file as a New Jersey non-resident, allocate 100% of my wage to New Jersey, pay the tax. Now New York's auditing me for my credit. That audit may take a little while. They get to the end of that and they say, you've overpaid tax to New Jersey. We want to disallow some of your credit. Now I want to go back to New Jersey to get that money back, right? There might be a statute of limitations that's run.
Right.
And people usually get mad at their accountant. Because if the accountant had done it right on day one, you would have paid New Jersey what it was owed. You would have paid New York what it was owed. No, zero-sum game. Mm-hmm. Now you've got to come up with money and you can't get a refund because the statute of limitations might have run where you overpaid. That makes people quite unhappy.
No doubt. You do not want to be caught. I was going to say with your pants down, but it's more with your wallet out.
This is a family show, right?
Yes, indeed.
All right.
Never amend a return under audit. This comes up a lot too. And it's such a weird one because it's like the first thing that everybody always wants to do. The accountant is always like, oh, well, just let's go and we'll amend the return and we'll fix it. And
imagine how that looks to an auditor. You filed a return under penalty of perjury. And as soon as the auditor said, let's look at it. Oh, it's wrong. I mean, Drew, we've seen this.
Yeah. I mean, the other reason, right, putting that aside, which is you filed the return, now you're being audited, now you look silly saying I'm going to change it immediately before you've had a discussion. But the more practical thing I always tell people is there's simply no reason to, administratively, right? Mm-hmm. If you amend a tax return that's under audit, the return is going to get flagged and sent to, guess who? The auditor who's conducting the audit, right? So it literally, just from an actual correcting the tax return standpoint, it accomplishes nothing, right? You can, if there is a mistake on the tax return, and you, as the taxpayer, now that you're being audited, want to come clean about it, you can just talk directly to the auditor about it. They can make the adjustment in the context of the audit they are conducting. There is no reason for you to amend the tax return.
I think, Drew, that the reason people might do it, one of the reasons, is that they think that if you come forward voluntarily, it will eliminate any penalties that might be imposed on you. And I would just suggest that auditors look at it two ways. One, when an auditor's got a gun to your head, it's not exactly voluntary anymore. And secondly, many auditors have told me that it looks like your client got caught with their hand in the cookie jar, right? Mm-hmm. The first thing they did is amend the return that they'd filed, and only because they're audited. So I don't think it helps at all.
Yeah.
Well, that brings us to the end of our written list. But as we've been going through, has anything else popped into either of your minds that should be raised for the listeners out there?
No, I think you really covered the landscape.
Yeah, I mean, the one big trap that is not kind of listed here that we haven't hit on that very often comes up in change of residence is the accrual issue, right? So this means when I change my residence, I have to think about whether the income I'm going to get after I move accrues to my period of residence. And if it does, New York is still going to try to tax it, right? So when we talk to people who make a move around an income event, I'm selling my company, I'm going to, sell, in Mark's example, a bunch of Google stock. We got to make sure that the change of residence happens and is clear as of a date before the income accrues. Otherwise, New York's going to get to tax all that income, even if we have a really clear change of domicile.
That's an excellent point, Drew, and something to keep an eye out for those of you out there who are moving in regards to the sale of a business. You have to be cautious as to when that sale is, firmly closed and the income from it is fixed and determinable. Sometimes those things actually happen before you sign on the final dotted line because there's usually pre-agreements and letters of intent and a bunch of paper trails that are created long before you sign the final contract. And you never know based on the wording whether one of those earlier letters was sufficient to have that income actually accrue to you. Guys, this has been an excellent discussion. I think that we have provided our listeners with ample amount of sound non-advice because this podcast does not constitute legal advice. But certainly the things we've said here are more trustworthy than the things being said at the country club in the locker room by people who do not have law degrees or law licenses. With that said, any final thoughts from either of you?
No, I mean, just what you said, right? I mean, these are traps. So if any of these ring a bell, it's just a really good reason to seek actual legal advice on these questions.
And I think the issue is seek legal advice before you move because, as Drew pointed out quite accurately, you can't unring a bell. Once you do something and it's submitted, that's it.
Indeed. For those of you out there listening, I hope you enjoyed this episode on our top residency traps and common residency mistakes that we see in the world of New York tax audits. For those listening, I have been Joe Tantillo. This is State Tax Talks. Thank you once again to our guests, Andrew Wright and Mark Klein, for joining us, and we will see you all at the next episode. Thanks for joining us for another episode of State Tax Talks. If you're interested in listening to more episodes, we're available on all platforms where podcasts can be found, including YouTube. If you enjoyed this episode of State Tax Talks with Joe Tantillo, please give us a 5-star review on your favorite podcast platform. And if you're in need of a tax professional, you can contact the tax attorneys at Hodgson Russ. Go to www.hodgsonruss.com for more information. And until next time, I'm Joe Tantillo, and this is State Tax Talks. Catch you later, tax fans. The comments contained in this podcast do not constitute legal advice. The opinions herein are the opinions of the speakers and not the official opinion of the Hodgson Russ Law Firm.